Slide 9 is based on our co-investment loan database. And as most of you know, we're probably a leader, if not the leader in the North America market doing co-investments. This is a great database for knowing what is happening real time in the first lien direct market. As you can see, yields on new originations are rising from increasing base rates, widening spreads, and increased OID, reaching double-digit levels over the last few months. Finally, in slide 10, Phil, we go comparison shopping for yield and look at yield opportunities across treasuries, high-yield bonds, levered loans, broadly syndicated levered loans, the CDLI, again, a proxy for direct lending, and enhanced lending, higher risk credit strategies. First, a reminder on the calculation of yield. There can be a huge difference between current yield in column 1 and yield to maturity in column 3. Current yield equals coupon divided by price. It assumes that the investor will get the current price back at maturity, no more, no less. Okay. Yield to maturity is different. It equals coupon, same as current yield, plus either the price discount or if there's a price premium minus the price premium divided by both the coupon and that discount or premium divided by price. It assumes that any price discount from par, which we're seeing large discounts currently across liquid and to some extent private debt, those discounts will be earned over the remaining life of the bond or loan. We call this additional return pull to par, and we show it in the second column. So if you take the current yield plus the pull to par, you get the third column yield to maturity. Okay, there's often a lot of confusion when people cite yield. Some cite yield to maturity, some cite current yield. Except for treasuries in that first row, the pull to par numbers in the second column are best case numbers. We know, for example, that high yield bond losses average 1.5% per year. That's a long-term historical average. So that 2.2% pull to par number for high yield bonds is not likely. That 2.2% assumes there are going to be no losses. Okay. It may, in fact, actually be negative if high yield bond defaults are above their historical averages. In columns 4 through 6, these are backup columns. We wanted to show average life price and coupon on November 30. These are inputs for calculating pull to par. Finally, in the last column, we extrapolate yields from November 30, about a week ago, to December 31, based on future reference rates from the forward yield curve. So nothing else happens except the yield increase is already baked in from the base rates already baked in at November 30, or based on the forward curve at December 31. Those returns in the final column would be the yield to maturity at December 31. So when I'm thinking about 2023, I would start with these yields in the last column, but I would adjust them downward for the optimistic pull to par numbers in column 2. Obviously, no adjustment would be needed for treasuries, okay, because there are no defaults, so hopefully. But I would probably knock 1.5% off the yield to maturity on high yield bonds for its long-term loss rate. I'd probably, if we're talking about market averages, knock off 1% for levered loans, the CDLI, and enhanced lending for what I would say would be average loss rates.